Folks, today we're talking about public versus private REITs, real estate investment trusts. It's a fantastic topic. Can't wait to dig into it. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group here at Canaccord Genuity Wealth Management. All right, so public REIT versus a private REIT. A public REIT, I think most people likely understand what that is. Maybe not, but regardless, it is a REIT, a real estate investment trust. Maybe we should start with that. A real estate investment trust is a trust that is organized, owns real estate. They own either commercial or residential or industrial, regardless, they own real estate. It's owned through a trust. Trusts, the units will trade on an exchange, and those units are liquid, they're merchantable, they trade on a daily basis, millions and millions of shares. You and I can go and buy those units, much like a stock, and we can put those in our portfolio, we can invest in them, and we can own that asset class. It's not easy to own real estate. Everyone knows we'd love to go out and buy a shopping mall that costs $3-4 million and collect the rent, pay down the mortgage, and hold on to the cash flow for us. But it's very difficult to do if you don't have a ton of capital. So the REITs allow that investment opportunity. So today we're talking about the difference between the private and the public REIT. So the public REIT trades on an exchange, produces very, very tax efficient income. The REITs generate what's called return of capital or ROC income. Because they're allowed to depreciate the value of their building, it is a known and used, I'll call it a tax advantage that REITs, that are favorable to REITs. Because of that advantage, the cash flow that is generated by REITs end up being very, very tax efficient. Most of the time, it's almost all tax-free. So it's tax-free in the year you collect it, and you're effectively deferring your tax bill down the line. So down the line, when you do sell or when your ACV has gone to zero, you then would crystallize a gain on the property, on the REIT, and that will become a capital gain. So not only are you paying no tax today, you're deferring it, and when you are selling it, you are converting it to a capital gain, which, as you likely know, is a much, much more favorable tax outcome than income. So capital gain is taxed at half the value of income. So you buy a REIT for $10, you depreciate it to zero over time, you sell it for 20, that means your cap gain is $20, you only pay tax on the 10, which is a very, very favorable tax situation. Now, REITs have generally been kind of slow growth, high income producing vehicles. So they're generally less volatile and have less of a beta and less of a correlation to the stock market than your typical TSX or Dow Jones industrial stock, which is favorable for some investors. So it's super tax efficient, it's usually less volatile, and usually has a steadier pace than the typical stock. So a public REIT trades, you can buy it, anyone can purchase it, put it in your RSP, put it in your TFSA, do whatever you want with it. A private REIT does not trade. A private REIT remains a real estate investment trust. Usually will be sold by offering memorandum. Usually will be for accredited investors only, meaning you need to meet a minimum amount of income and a minimum amount of assets. So typically it's going to be kind of the $250,000 annual income range, and either the $1 million liquid or $5 million in total assets. Now the reason they have this accredited investor is because there's a concept in the investment world where if you're a sophisticated investor, if you've accumulated wealth, you don't need as much protection from the regulators as the typical consumer. Whether it's right or wrong, I'm not going to comment on it, but it's a fact with respect to private REITs that you generally need to be an accredited investor. So much like the public REIT, they're a trust, they are formed, they sell units, but different than the public REIT is they do not trade on a daily basis, which will generally mean that your volatility is dramatically reduced. I mean dramatically. Usually the private REITs are evaluated or valued quarterly, some are monthly, some are quarterly. So if today our properties are worth $10 a share, $10 a share will be the value on your statement. In 3 months, if they're worth $10.10 a share, that will be the value on your statements. And generally, they will not move for that entire period. They don't trade. They are by definition private, which means they do not trade on an exchange. Now, liquidity is also a factor that you need to consider here. So the public REITs are simple. You put in a stock trade today, you sell, you get your money in 3 days, everyone's happy. Generally on the public REIT side, liquidity is different. It's not T+2. You don't get your money in 2 days or 3 days. Generally, it's either monthly, quarterly, or even annual liquidity. You get slightly less liquidity. Liquidity means the opportunity to sell your units and convert to cash. Generally on the private side, you'll see, because it's accredited only, because they're less need for liquidity, usually they can take longer positions and have a stronger balance sheet in place. And generally what we've seen is a little better return profile on the private side than on the public side. You lose a bit on the liquidity, but you gain generally on the actual returns. And the neat thing is way, way, way less volatility in your portfolio.
In this video, I'm going to break down investing in REITs versus direct real estate investing to help you make a decision for as to which method is best for you. Real estate's a very versatile asset class that's definitely worth having in just about any portfolio, even if only for diversification purposes. There's a lot of great things that you can do with it to produce pretty high returns, leverage it, and do all sorts of great things. But before I get into the advantages and disadvantages of REIT investing versus direct real estate investing, just wanted to introduce myself for anyone who might be new to the channel. My name is Jack Duffley, and I'm a 23-year-old real estate investor.
If you're the type of investor that doesn't like to see the value go down in the shares that you own on your statement, you would love a private REIT because they generally don't move. They move quarterly a tiny bit. They pay their income. The income is, again, ridiculously tax efficient, and it just makes a ton of sense for a retiree or anyone who owns assets in a corp or who's got a tax problem and wants to keep their tax burden low.
REIT is a real estate investment trust, and it's a creature of the US tax code, but it's generally speaking a real estate investing company. A company that designates itself as a REIT must be predominantly a real estate investment company. It can't be investing in all sorts of other things, can't do something else for its main line of business. It is specifically supposed to invest almost all of its money into real estate. At the same time, in exchange for having no corporate tax at the company level, a REIT has to pay out the vast majority of its income to its shareholders as a dividend. Now, I should just flag this here. Generally speaking, REITs are not tax efficient like many other dividend stocks. This is because of that tax benefit for the company that I already mentioned. They don't have to pay any corporate taxes as a REIT. But the government, of course, wants to get its money somewhere down the line, so the actual dividends that are paid out to investors are then taxed as ordinary income. Generally speaking, obviously speak with a tax professional for your situation. REITs can invest in all sorts of different types of real estate, ranging from multifamily properties, single-family properties, industrial, retail, farmland, even mortgages can be their own sort of REIT. Student housing, pretty much any niche in the real estate industry you can think of, there's probably a large REIT for it. So that's what a REIT is, and I'm going to compare this to direct real estate investing, which is where you, the person, or maybe you own your own individual company, and you buy the real estate directly. You own it and control it yourself. You're not buying it through some other entity like a REIT. So I'm going to quickly go over the similarities between REIT investing and direct real estate investing, since they're pretty self-explanatory and you probably already know them. And the bigger thing I want to get into is the differences and the advantages and disadvantages between either choice. Both types of real estate investing give you rental income, and that's always a great thing. That's what people are looking for when they invest in real estate. They want that passive income. And real estate investors sure love passive income. Passive income. Whew, oh, that'll get you going. All right, back to it. Passive income, rental income, that's going to come with either type of real estate investing, whether it be in REITs or direct real estate investing. And you'll also get appreciation if the property goes up in value, if the REIT works on the property and improves it, if you directly work on the property and improve it, or you somehow boost rental values in some way. These are types of a forced appreciation that you can get in either type of real estate. The difference is how you actually get them. With a REIT, the company's doing it, but with direct real estate investing, you're going to have to do it. And the last thing that both types of investing will get you is exposure to the real estate market. So if you're looking for diversification, it's a great way to add a different type of asset class. If you have maybe a broad portfolio of stocks and bonds, then you can actually add some real estate in there to get a different sector involved. But you probably already knew that, and what you want to know are what the main differences are between REIT investing and direct real estate investing. So let's get to that. The biggest difference generally stems from control, and that with a REIT, you don't really have control over the day-to-day operations of whatever's going on with the property. You don't really have control on deciding the direction of the REIT unless you have a huge portion of the outstanding shares, in which case you'd be like a managing shareholder, but that's probably not the case. Whereas with direct real estate investing, you own the whole property. Maybe you have a partner on board, but then you're still a large shareholder, if you want to call it that, of the property. You are deciding what's happening with it. That is a big deal, since you can decide whether you want to do rehabs, whether you want to make changes to the property, you want to try and rezone something, you want to flip it, you want to hold it for the long term. You have a lot more flexibility because you have so much control. However, on that topic of flexibility, REITs are more flexible in one particular area, and that's generally liquidity, in that you can buy and sell REITs more often than not. You can buy and sell them freely on the open market. It's very easy to add to your position or to subtract from it and get the money back out. Whereas if you own a single family home, for example, you're going to have to make sure that that property is ready to list. You're going to have to list it. Then you're going to have to go through the closing process. If your buyer has a loan, that'll take many weeks. Generally speaking, you're not going to be able to sell property faster than a couple weeks or so, or usually even a couple months, depending on your market and what you're pricing it at and what you're trying to actually get out of the property. You can certainly close a lot faster, but then you're going to have to reduce your buyer pool or otherwise slash your price, and that's going to hurt the liquidity of your investment. And another very important distinction to make between REITs and direct real estate investing is the fact that it's very difficult to get something below market value when you're talking about investing in a REIT. Whereas with direct rental property investing, you can make offers below the apparent market value and you can try to get a very good deal on a property. Whereas with the REIT, if it's trading on the public market, the price that's there is the price you will pay. You're not getting anything better there unless you wait and hope that the stock price actually comes down to the point that you can buy into the REITs below the alleged value of the real estate, but that doesn't always happen. It's very rare that that will happen. And this isn't to say that it's easy to get rental properties under market value even when you're investing directly, but at least you can a lot more easily than with a REIT, because the REIT, you're going to have to wait for that stock price to move, which, like I said, doesn't always happen. But if you can get a property under market value, that's a lot of instant equity there, and that is more flexibility for you, the investor. And another big difference, which I kind of highlighted earlier, is taxes. When you're investing in a REIT, you generally don't have any tax benefits. The benefits are actually the company's. The benefit to the company is that it doesn't have to pay a corporate level tax when it's a REIT, but shareholders will generally have to pay taxes on their dividends. This isn't to say that the REIT isn't also taking advantage of tax deductions, but they're not going to necessarily be as potent on your personal tax return. So I suppose the overarching consideration to make here is ease. If you want a very easy investment into real estate, into rental properties, then buying into a REIT is a great way to do that very quickly and with very minimal effort. Whereas if you want to own properties directly, that's going to have a lot more effort. You're going to have to set up systems. You're going to have a property manager or manage it yourself, which is time and work. There's a lot more work that goes into direct real estate investing that you're going to have to do. Whereas with a REIT, the company is doing it all for you. The REIT needs to make profit too. The people who manage the REIT, they're taking some profit on the front end, and then you're getting what's left as dividends. Whatever the case, real estate is definitely a powerful asset class that's worthy of consideration for any portfolio, whether it be for diversification purposes, creating more income, different income streams. It is a powerful asset to do that. REITs are just one way to get many of those benefits, whereas investing directly is another.